Hi, and thank you for joining us on Real Estate for Millennials. My name is Sara Shahmoradian, aka Millennial Realtor LA, and today we'll be talking about the loan process after escrow has opened. We have Chris Eskandarian here with us today. Thank you so much for joining us.
My pleasure. Thanks for having me. So I'm with HouseAmerica Financial. Once again, Chris Eskandarian. We are a direct lender. Been in the business for over 8 years now. We do residential home loans, financing of it. In 2018, I was ranked top 1% in all of America.
Awesome.
2019 numbers aren't out yet, so I should be there. We'll know in a few months.
We'll see.
Yes. So yeah, I'm here to kind of just share with you guys on how the process goes. I myself, just like you, deal with a lot of first-time home buyers. So just wanted to kind of explain and kind of clarify some questions that
we get
any of our viewers would have out there.
Yeah, and we have worked on a deal together before, and that was a first-time home buyer also.
That was, yes.
So and you did amazing. You were so clear with them, and they had so many questions, and they weren't afraid to ask you because you were so open and
Absolutely. I think it's teamwork. It's both of us. We educate them well. They were happy. They were satisfied.
They were.
And yeah, I mean, that's just kind of how it goes.
Yeah. Thanks again for being here. So Let's get started. Again, I just want to explain that we already had the pre-approval process. So if you haven't seen that episode, go ahead and take a look. And this episode will be more about after escrow opens, what happens with the loan process, and kind of the more in-depth questions I get about the loan itself and how to obtain that loan.
Of course.
So let's go ahead and start with what is the loan process after escrow opens.
Yeah, so once escrow is open, meaning offer's been officially accepted, we reach out to the clients, congratulate them, ask for updated documents, whether it's W-2s, pay stubs, tax returns, bank statements, whatever it is, we ask for those documents. Once those documents are in, we send out initial loan disclosures, kind of breaks down the terms of the loan. So it's obviously, the rate and the terms is something that we start discussing with the clients because you're normally able to lock the rate once offer is accepted. So we send out loan disclosures once they're back, once the documents that we requested are in, we send the loan to processing and underwriting. After the loan is underwritten, loan is approved, we get the loan to docs, we get loan docs are signed, and that's just kind of pretty much the whole process.
We're going to break this down.
Yeah, quick synopsis.
Yeah, we're going to break this down, but that's definitely the outline of how the process works. So let's go ahead and talk about the underwriter. This is a really important part of the loan process. They're really the people that have the last say. Mm-hmm. So who is the underwriter and how does that process work?
All right, so an underwriter, like for us, for instance, is somebody in our office. So we have about 3 underwriters in our office. Underwriter is a person who makes the final call on the loan. They normally go off of the guidelines that are set by investors. So they review income, credit, and assets. Based on what the guidelines require, they have to be able to meet those guidelines. And if for some reason they don't, the underwriter will condition for something or potentially decline the loan, which we never want to see.
Right. So what is the difference between getting the pre-approval and the underwriter approving?
Loan approval, yeah.
The loan approval. So what is that?
Question. That's a good question. So the pre-approval is when documents are submitted to someone like myself, the loan officer. I review everything. I issue the pre-approval. I should be doing a thorough job, which I do, because once the loan is in underwriting, there's got to be nothing that can actually decline that loan. So the underwriter is pretty much doing what the loan officer does, but a little bit more in depth. So they analyze the credit report. They look at the income. If the loan officer missed something and the underwriter catches it, you may be too late in the game at that point, because now you're waiting to remove contingencies and you're in escrow. So it's the loan officer's job to do that thorough pre-approval to make sure nothing is missed and being caught down the line. So the underwriter is pretty much double checking the work of the loan officer.
Okay.
But it's not when documents are submitted to us for the pre-approval, we don't submit it to underwriting. We review it. Yeah. It's our job to do the pre-approval. So we have to make sure we're thorough.
I just want to actually say a quick example. We opened escrow and all the docs went to underwriter, and the underwriter actually caught something on the RPA that didn't really add up to the loan pre-approval.
Yes.
It wasn't a big problem at all. It was not it was literally a box checked.
Correct.
Investment. She was like, literally just go uncheck that box and resubmit it. And it was no problem whatsoever. It was actually about if the owner was going to occupy the property or not, which is another thing maybe we should touch on.
Sure.
That the owner occupied is a different rate than an investment property.
Correct.
And that RPA had the box checked for not owner occupied, and it was owner occupied. So she just told me, go ahead, uncheck that box, resubmit it, because my investor won't be happy if they saw that on the RPA and we were giving them a different rate. That's literally what happens. So the pre-approval, you get that, right? You get the letter of pre-approval, you get your offer accepted, and then the loan officer go ahead and gets all the information that they need. They need like detailed stuff. They then take all that information, submit it to the underwriter who then rechecks everything, double checks everything, make sure everything makes sense, make sure their investors are going to be happy, and then that's when they approve it, right? So once they approve it, you can then go ahead and release your contingency. Now, the contingency dates are really important. A loan contingency date is something that is written on your RPA and is agreed upon. A standard loan contingency, which is already on the RPA, is 17 days,
17
correct?
days, correct, yep.
In LA, to be more competitive, we have started putting 14 days. So 2 weeks. No issue.
Yeah, I mean, in this market, you got to get attractive, you got to be aggressive, you got to be creative. So, I mean, my offers are going in at 10 days.
10 days. I know. I just did one at 10 days. So with LA, there's a lot of competition, as we all know. So with the loan contingency, we've been cutting it down lower and lower. That is approved by your loan officer. You never want to put any number other than 17 days unless it's approved by your loan officer,
correct,
which your realtor should be doing. Should be having communication with your loan officer and getting that approved.
Making sure that's
making sure
correct,
they have the right information for that or are ready for that, and their underwriter doesn't have a pile up to here and so forth. So
correct,
that's really important to understand. So we talked about underwriter and the contingencies. Now let's go ahead and talk about the owner occupied.
Okay. So owner occupied compared to investment properties per se. Owner occupied is when you're planning on living in there. Investment when you're planning on renting it out. The interest rates, the down payments differ on an owner occupied than as on an investment. Owner occupied, you're looking at better interest rates. As far as the down payment, you can go as low as 5% down. Whereas on an investment, the rates are higher. And then as far as the down payment, you're looking at least 20-25% down. You know, you're typically not able to put less than that. There are ways of putting 15% down, but the rates way too high.
Too high.
There's mortgage insurance. It's not something that I even pitch to clients, to be honest with you. Nobody's going to take that offer. So that's the main difference between the owner-occupied and investment. And to your point about checking that box in the RPA, normally when you check that box, you're indicating that it's going to be purchased for investment purposes. So when it's not checked, it's for owner-occupied. So if you're submitting a loan to underwriting as an owner-occupied, you got to make sure that box is not checked. Because if it is, the underwriter is going to catch that, and they're going to want you to make that change. Buyer and seller have to initial and sign and agree that the buyer who's purchasing it is buying it as an owner-occupied, not an investment.
Which it's fine. Like it's not that it sounds worse than it is.
Yeah,
it's not a big deal at all. I did
correct,
it in 2 minutes. It wasn't an issue. Nobody
correct,
had an issue with it. The seller surely doesn't have an issue with
agreeing to that. Yeah, it doesn't. But just the fact that they both have to sign.
Right.
I literally had one a week ago.
Yeah, it happens all the time.
It happens.
Yeah.
It's really not a big deal.
Okay.
So that's the main difference between
owner-occupied and investment.
Yes.
So let's go ahead and talk about loan docs, because you just mentioned it about loan docs. So once the underwriter has approved, then we have loan docs, correct?
Correct.
Funding and loan docs. Let's talk about that.
So once the loan is approved, after we get the closing disclosure out, the CD, you guys may have heard of this if you've purchased before. If not, don't worry. It's really not that big of a deal. 3 days after the CD is signed, meaning after you've agreed to like the terms, the figures and stuff, and you've kind of reviewed preliminary figures prior to the final loan docs, you're able to sign the final docs. So 3 days after the CD, you're able to sign the final loan docs. Final loan docs and escrow documents are all signed at once, either at your house where a notary is sent out to you, or at our office, or at the mortgage company, escrow office, wherever. There's a notary that signs the documents with you. This is not something that you can e-sign or just sign and send back. It's got to be in person with the notary. They do the whole thumb thing and all that good stuff. So yeah, they pretty much sign docs in person. Docs go back to escrow, go back to the lender, and then we fund the loan. Typically, the loan funds a day after loan docs are signed, as long as the funds have been wired to escrow the day prior and it's already hit escrow prior to our funding, because we got to make sure those funds have hit escrow prior to us funding the loan.
And this is a very good day for us. When
Yes.
loans are funded, we are celebrating.
Yes.
Where that's like, the almost the end. You can see the light at the
much.
end of the tunnel. It's really the end of
Yes.
your escrow period. So once you've funded the loans, we're saying congratulations. Everyone's congratulating each other because that's really it. What happens after that is with escrow, and it's just like minor stuff, like getting it recorded and all title, and we've already talked about that. So getting the loan funded is like a really big day.
Yeah, once you get that call, loan is funded, you're pretty much done.
Yeah, you're pretty much done.
I mean, shouldn't be saying this, but during the escrow process, you're not allowed to charge your credit cards and lease a car, co-sign with anybody on anything. But after your loan funds, you're kind of able to do those things.
Yeah, you're like free now.
You're free. And it normally records the following day, right? Escrow normally records the next day. So you fund and the next day it records, assuming it's a business day and not a weekend.
Yeah. Yeah, you never want it to fund on a Friday because then you have to wait till Monday.
You have to wait till fund day, and then you got to pay the interest over the weekend.
Yeah.
So yeah, you don't want to fund on a Friday, correct?
Yeah, we've always funded on Thursdays or Mondays.
Yep.
Always a thing.
Thursdays are probably one of the better days.
Yeah.
Because then Friday you get the keys and then you got the weekend.
Yeah, that's true. Let's talk more about details and advice for getting the loan and how to go about that, because I get a lot of questions and I sometimes don't even know how to answer them because I am not a lender, I'm a realtor. So let's talk about if it's better to have one name on the loan, or is it better to have every family member on the loan? How does that work?
Yeah, so that's a good question. So as long as whoever is getting on the loan helps qualify, yeah, put them on the loan. I mean, if the person doesn't have good credit scores, doesn't have income, there's no purpose of you having them on the loan. I mean, you can just have them on the title, right? You could have as many people on title. So having one person on the loan or 10 people, if that other 9 people are not helping you, there's no point of having that extra 9 people on the loan.
How does co-signing work?
Yeah, that's pretty much co-signing. So there'll be a borrower and then a co-signer. Both people would be on the loan, and they both, there's no like somebody has more rights than the other. It's pretty much like 50-50. They're both on the loan. So, if you were to buy a house and you wanted to have one of your family members co-sign for you, they would pretty much get on the loan. Like that loan that you're applying for is going to be on their name too. So if they were in the future planning on buying something or doing something, this loan is going to be under their name. So they're pretty much co-signing. So they're taking on the responsibility.
This happens a lot with kids, parents and children.
Yes.
And especially with our millennial generation not being able to afford homes by themselves, it's very common that a parent would come in and co-sign.
Yeah, for their child. Yeah, we see that a lot. We see vice versa, where a child is buying for the parents because the parents are too old.
Yeah.
So we're seeing that a lot more nowadays. Younger people, they want to help their parents out, so they help co-sign, or they buy for their parents. So vice versa, that's totally fine, as long as they qualify, right? So you got to take their income, take their expenses, take their debt, and make sure they qualify. And that's something that's where we come into play. That's stuff that you get over to us. As far as the documents, we review it and we tell you whether you're good or not.
Right.
Co-signing or not co-signing.
Yeah. Okay, that makes sense. And let's talk about married couples, because I get this question asked all the time about married couples. Is it better to have a joint account, separate accounts? Does it matter? Do they look at both accounts? Do they look at the funds and all that kind of stuff?
So there's no better or worse as to joint account or just an account with one person on there. All we look at is to see if the funds have been seasoned. We don't look at all your accounts, but just the account that we're using for the purchase. So if you've got $50,000 in one of your accounts and you've got $5,000 in the other, and you don't plan on using the other $5,000, the account with $5,000 in there, then we're just going to take the account with $50,000. I mean, we're not going to provide to the underwriter.
When you say take, you mean look into?
Look into, correct. Yeah. To check for any large deposits and so on and so forth, to make sure those funds are okay to be used for the purchase transaction. If that makes sense.
It makes sense to me. I'm hoping it makes
sense for them, yeah. I mean, it's pretty simple. I mean, the funds got to be seasoned in your account for at least a month. Most programs require at least 1 month. Some programs require 2 months of seasoning. If you have like a $30,000 cash deposit, pretty likely we're not going to be able to use those funds.
Right.
Meaning it's not a decline. We're not going to decline your loan. But if you have $50,000 in your account and $30,000 of it was just put in your account as cash, we're going to use the $20,000. The other $30,000 we're not going to be able to utilize.
Right.
So you've got to get a gift from someone, or we got to figure out a.
Yeah, this is what I want to talk about, gifts.
Yes.
Because again, as I just mentioned, young millennials, first-time home buyers.
Yes.
They are getting money from their parents
Correct.
to pay the down payment.
Okay.
Not all, but a lot of them are.
We see it all the time.
And it's okay that you're doing that.
Yeah, it's totally fine.
Don't be like ashamed or embarrassed. Like everybody is doing it, especially in Los Angeles, because house prices are so high.
Correct.
And there's not that much
inventory.
There's also, you as a person don't have as much cash flow as your parents did at our age. So a lot of the time parents are paying, or grandparents are paying, the down payment, or some of the down payment. They're gifting
Contributing, yeah, of course.
How does that work? What is the best way to go about it?
Okay.
And how can they avoid any problems like what you're saying right now about the large deposits?
So yeah, I mean, the gift can be either transferred to your bank account from the donor. So let's just say your parents gifting you. Your parents can transfer the money via a check or a wire transfer to your account. Or they can just transfer it directly to escrow. But whoever the money is coming from, it's got to be a family relative. It can't be a friend, right? It can't be just like a stranger. I mean, the gift has got to be a legitimate family member. We ask for a gift letter to be completed.
Oh,
So
cool.
we
I didn't know that.
we as a mortgage company, we send out a letter. It's already kind of like put together, and all you got to do is just fill in the blanks.
Okay.
Yeah, so you just got to fill it out, and it's signed by both the person who's receiving the funds and the donor, and that's what pretty much makes it executed. We submit that to the underwriter with proof that the money was transferred from the parents to their account. That that whole kind of like the process of it. Or if they're going to be transferring it to escrow, then the wire confirmation receipts. Well, wire confirmation receipts we're going to ask for either way. So it's pretty much after you wire the funds, you get like a confirmation receipt. It's like a big full page. So you give that to your loan officer, and that way all the details of the transaction are on there, as to where the money was sent to, from what account it was sent from, for what amount, and so on.
So
and so
they
forth.
shouldn't be transferring money before speaking to a lender.
Absolutely. Don't move money around.
Don't move money around. If you're trying to buy a house, talk to a lender first. If your
Correct.
parents are going to gift the money, it's fine if they do, but make sure that you're following the guidelines of your lender. And I think that it's a very common thing that people are doing now. So it's really important to know these details.
Absolutely.
Okay.
Absolutely. I think we're hitting up on some very good.
I think so too.
Very good points.
I get asked these questions daily, so
Absolutely.
it's really important to know all this
Likewise.
stuff. So let's talk about the down payment. Okay. How much do you actually need to buy your first home? I know that this percent has gone up and down throughout the years, but now it's like kind of, we don't really know the answer to this question.
I mean, there's all sorts of programs out there. I mean, I've heard of programs with 0 down. I know they do have some crazy restrictions on it, overlays and stuff where it's not as easy to qualify for it. Typically, you're looking at least 3.5%, or 5% down. 3 or 5% down is a conventional loan, and then 3.5% down is an FHA loan. I think that's just too much to get into as far as the details of each one. I'm sorry. Right. But I would say try to have at least 5% down. That way your interest rate is not as bad, and then your mortgage insurance factor is not as bad. But for a first-time home buyer, on average, what we see is either 5% or 10% down.
10%,
We're seeing that as a lot.
People have been asking me, like, where do people get all this 20% down? How do they have so much money? And I'm like, I think I've put like 2 or 3, offers in at 20%. Usually now it's 10% or even lower. So don't worry too much about the down payment. I know cash flow is very hard. It's hard, especially now. If you have money saved up and you think that you can afford something or you're ready to buy a house, talk to a lender.
Yes.
Because they will tell you exactly what you can afford, what you can't afford, and how to get from point A to point B so that you can actually afford to buy a house, and what you need to do and how much down payment you need, and even the dollar amount of what you need and what you can do to get there.
Correct.
So I think it's so important to talk to a lender, because you guys literally are like, okay, if you want to afford this house, you got to do this, 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 and this.
Correct.
And they're like, okay, check, check, check.
Yeah, I mean, if you tell us like pretty much what range you're looking at and how much down you have available, we can tell you what your payments would be. If you're okay with those payments, if those payments are comfortable with you, then you're pretty much good to go.
Yeah.
But if you're looking at a house that's worth $900,000, but as far as payments go, you're going to probably be okay with $500,000, house payments, for instance. There's no point in you looking at that $900,000. Talk to a loan officer first, get educated, know the differences between the payments at $500 and $900, and then go out there and start house hunting and shopping.
The loan officer can also always can run numbers for you, and they will tell you exactly how much your loan payment, your mortgage payments will be monthly, and they'll ask you, as you just said, are you okay with these monthly payments? Do you think you can afford these monthly payments? Okay, then you can afford to buy this house, or this house.
Correct.
Yeah.
Correct.
Okay.
Yep.
Really important stuff.
Absolutely.
Okay. When the deal closes, are the buyers of that new house paying the lender the mortgage payments, or are they paying the company? How does that work?
Sure. So once the loan funds, depending on who your mortgage company is that you're working with, the first payment is probably made to the lender. And then after the first payment, when the loan is sold or transferred to an actual loan servicer, payments are made to the servicer.
They'll bill.
Yeah, so with me, like, you get an email from me, pretty much giving you details as to who the payment's going to be made to, and they'll mail you documents as to kind of like a package as to who your new servicer is, and payments are to start going to them. Typically nowadays, almost everybody has that whole auto pay kind of thing set up, so it's very simple, very easy. Once you do that, you don't have to worry about it. It's on auto pay. You could apply more towards principal every month, which is something that I recommend you do if you're able to do so. Any additional amount that you apply, just an FYI, any additional amount that you apply towards your mortgage every month, say your mortgage payments are $2,300 and you want to apply $2,500, that additional $200 a month is applied directly to principal.
They won't know what principal.
So your principal loan, so your loan amount. So your loan amount is $600,000. So your loan amount's going to drop by an extra $200 every month. Does that make sense? In addition to what amount's being applied towards the principal, because with the mortgage, you're paying to the interest and the principal.
There you go. Okay, I think we need to explain that. Okay, so when you're paying a mortgage payment, I know this, but I know this because I'm in this job.
Sure.
When you're paying a mortgage payment, there's a certain amount that is going actually towards your house, and there's another amount that's going towards interest. Okay?
Correct.
And it sucks, but that's just how it works. A lot of it is going towards just interest and not actually paying off your house. The portion that is paying off your house is called the principal payment. What Chris is trying to say is that, let's say you get, you worked overtime, you got a big paycheck that month, and you're like, you know what, I want to put a lot of this towards my principal payment. I want to pay off my house as much as I can. You put an extra $200, $300, whatever you want, an extra $1,000. You put that towards your principal payment. When you make that mortgage payment with that extra amount, they actually deduct your principal payment amount.
Correct.
Did I explain that okay?
Yeah, you did.
Wow.
I mean, that was pretty good. That's pretty good.
I'm actually
you could be a loan
impressed
officer.
with myself.
Yeah. We should probably get you on board. No, I'm kidding. You're good. You're great at what you do, actually.
Thank you.
I really appreciate your trust. So yeah, that's pretty much it. I mean, I just wanted to kind of touch on that. So, there's an amount applied towards the principal and an amount applied towards interest. That's pretty much kind of like the recap of it.
Right.
And then anything in addition to that is applied to a principal reduction. So, your loan amount starts going
on the
down
actual
quicker.
physical house.
Correct.
Okay.
Correct.
And so so they start paying you the first month, second month or so, or
going forward
would
exactly.
be paid towards a company that has bought their loan. If you have any questions about, it's really complicated. If you have any questions about that, we don't want to go too deep right now. reach out to me or Chris. We'll explain how that works.
Absolutely.
But you won't actually be paying the lender directly throughout the whole time you have a mortgage.
Correct. Now, you wouldn't be able to call me and say, hey, did you get my bill? Unfortunately or fortunately, we don't have the time to take or field calls as to whether your payment has gone through. So that's something that's done through a loan servicer. So
And
the term servicer is like pretty much somebody who's receiving the payments.
And don't forget, your loans are usually 30 years. So
Correct.
your lender's not going to be answering your phone call every month for 30 years to
Make sure your
payment went
gone
through.
Yep.
So that's why they have a servicer. They have a company that actually deals with that.
Absolutely.
Completely to themselves. And
Correct.
does the buyer continue to have contact with the lender after a deal has closed?
Absolutely. I'm in very close contact with a lot of my clients, even after we fund the loan, even after we're done with it. I try to get on a personal level with a lot of my clients, and I think that really helps. I think that goes a long ways, whether it's via email, postcards, a call, an email, a text. I really try to be in touch with them because, they have questions, and then there's a possibility of refinancing down the line, assuming rates drop.
We'll talk about that on another episode.
Yes, another episode. But, that's another thing. So you want to make sure that you keep your clients in the loop as to where the market is, where rates
Things
are.
change.
So educate them.
Educate them,
if they can save on their payments, why wouldn't you tell them?
Yeah.
So as a first-time home buyer, know that the person that you're working with should have your best interest in letting you know when stuff like that come up.
Of course. Okay. Property tax.
Yes.
What is property tax? How much is property tax?
Yep.
Let's talk about that.
Yeah, so property taxes, in addition to your mortgage payment, your insurance payment every month, there's property taxes. You can't run away from this. You got to pay.
Yeah, we're not trying to scare you, but
Yeah.
this is definitely something that you have to budget for.
Exactly. And that's why running the scenarios by us as to what you want to buy for and how much down you want to put and what the current rates are at the time so that the payments are affordable, this is something that we will send to you. We'll kind of break it down to make sure that you're aware of how much is going to be allocated towards property taxes. Property taxes could either be paid monthly or be paid twice a year, every 6 months. If you put less than 10% down, you're required to pay it monthly.
Okay.
Something a lot of people don't know.
I didn't know that.
Yeah, they kind of ask that question. It's not common that most people know, but less than 10% down, you're required to pay it monthly. So when you pay it monthly, it's being paid to your loan servicer. It's paid to the mortgage company, right? And then every 6 months, it gets dispersed from that escrow account.
And it goes to who?
It goes to the county assessors.
Okay.
Yeah. So it will pretty much go to the mortgage company. It'll sit there. The money accumulates there, and then it gets dispersed from there.
Oh, okay.
So
okay.
every 6 months, it gets paid out of there. So property taxes are normally in LA County. Every county has a different tax rate. In LA County, it's 1.25%. That's the base rate that we use to calculate your monthly property tax. So like for instance, in LA County, it's 1.25%.
Of the purchase price.
Of the purchase price, correct. So it's $500,000 purchase price times 1.25%. Whatever that big number is, you could divide it by 12 to see what your monthly is. Or you can just leave it that way and that's your annual. Divided by 2 and that's what you would have to pay every 6 months. So that's pretty much property taxes. But every county has their own. We kind of concentrate more in LA County, so that's off the top of my head. Ventura County, San Marino County, those are a couple other ones that we kind of are in as well with our clients. But so yeah, that's pretty much property taxes.
Yeah. If you don't live in the LA County, definitely talk to a lender that is local in your county and ask them about property tax. But it is generally, I know most of California it's around the same.
It's easy to Google as well.
Yeah, Google it.
So if you Google like San Marino County property taxes, you can pretty much just see all that stuff. It does vary, but it doesn't change that often. So that 1.25% base rate has been there for quite some time. That's what we use as lenders. It's not to say that 1.25% is going to be your property taxes going forward. It could be a little bit less than that. Okay, so it's not exactly 1.25%.
You're playing it safe.
Yeah, we always use 1.25 as the base rate, but it could be like 1.15, 1.10, somewhere in that range.
Makes sense. Okay, very important to know. Definitely budget for that.
Yes.
So you know how much you're going to be paying, maybe monthly or every 6 months, which your lender would have already told you at the time of even pre-approval. They would be able to have that number for you. So it's definitely something to consider and be aware of. Do you have any advice for first-time home buyers?
Yes. My biggest thing is don't co-sign with anybody on anything. Don't apply for new credit cards. Don't ding your credit. No late payments. You don't have a mortgage, so there's no mortgage rates that can arise. Don't lease a new car. Don't just deposit cash in your bank account. Talk to your loan officer. Let him advise you on what steps you should take to get those funds seasoned. Don't quit your job. Don't quit your job in the middle of the escrow process, or don't switch jobs without chatting with your loan officer. All of these things that I just listed here are things that, there's probably more than this, but these are just a few of the things that can hinder you from qualifying. So you got to be very careful. It's better you ask, even if you think that it might be a dumb question. Just ask. Ask. It doesn't hurt. It's a quick answer on our part. We should be able to get back to you fairly quickly. But that's pretty much it.
My advice is to get a loan officer that you trust, that you like to talk to, that is ready to answer all your questions, because as a first-time home buyer, it's very nerve-wracking, as it is for a lot of people, and it should be, because it's a huge purchase. And you need to be working with a loan officer who's ready to answer your questions, who's ready to pick up your phone calls, who is happy to help and is giving thoughtful advice to you. Because it's so important. The lender is such a big part of the real estate process. I, as a realtor, work very closely with the lender and make sure that the process is going seamlessly.
Yes.
And Chris we've worked on an offer together, on a deal together, and it went seamlessly, and it was perfect. And we closed early, I think, on that one too.
We did. We normally do.
Yeah, which happens. So, this was amazing information.
Thank you.
Literally, I get asked this all the time, and I think I learned a lot too. So thank you so much for watching, and thank you for being here. Please follow me on Instagram at Millennial Realtor LA.
And follow me at Chris Eskandarian.
And yeah, we'll see you next week. Thank you. Bye.
Bye.